My name is Alex Sadolf,
And I'm Brandon Cobb.
and this is the Land Development Accelerator.
We're excited to have you on today. So, and I'm not even going to pretend. How do you pronounce your last name? I was going to go for it, but I'm like, I better not try to butcher
Yeah,
it.
don't worry, it gets mangled every day. But it's Piasecki.
Okay, good deal. And then there's Alex. We'll let him in. So Justin is a capital broker. I know we've had some private equity companies, on this call and, lenders, but Justin is a great resource because he has connections with very high net worth individuals, institutions, family offices. He works with George Smith Partners. So he's connected to a lot of capital. So I want to interview him today, and then we'll do a Q&A kind of here at the end. Justin, for those that don't know you, tell us a little bit about you and about George Smith Partners.
Yep, absolutely. So my name is Justin Piasecki. I'm president of an investment banking firm called George Smith Partners. I'm an East Coast guy, and so actually working on my house today because I have some family stuff later this afternoon, but mostly working out of our New York City office in Midtown. The firm's been around for 40 years, solely focused on the finance side. Company's been based in Century City, so Beverly Hills-ish area of LA for all 40 years. So my headquarters is actually on the West Coast. So we have LA, New York, actually Alpharetta, Georgia. I would say Atlanta, but it's Alpharetta, Georgia office, Dallas, and Bellevue, Washington as of today. And I have a small satellite office in the northern suburbs of Detroit. Almost about 80 people, bankers, analysts, associates, full squad of finance people in-house. We focus on a couple things. It's all, for the most part, mostly all commercial. So that's everything from 10-unit townhome communities that somebody's developing to a large condo in Miami, hotel in Nashville, land banking facility for XYZ fund that is buying on behalf of a large home builder. It's kind of all across the board. Working on some data center deals right now. So asset class, it's pretty much anything and everything that's deemed commercial, built for sale properties and built for rent. It's been a big business the past 5-6 years for us. And we focus on raising LP and co-GP equity, so joint ventures, mezz and preferred equity financing. So people that aren't as familiar on the commercial side, it would be a second mortgage essentially in the resi world, and then obviously first mortgage finance. So that's everything from acquisition financing, construction, bridge loan, bridge to stabilization, and then perm type financing, whether it's life insurance companies, Fannie, Freddie, CMBS, banks, you name it. We work with these different types of institutions.
Yeah, and I know we were talking a little bit yesterday about just the size of the deals that you guys look for. I know y'all finished helping raise capital for a land banking fund where they're just banking land for a large national builder. That was a very large raise, and I know you do deals like as small as like 20, unit townhome projects. So I guess give us kind of like a range of the types of deals in like the land space that you're working on or have worked on.
Yeah, it's a good question. I would say luckily, for the past couple of years, as the build for rent world has really been booming, right? It's the cool hip thing, and starting to see the build for sale open back up in certain markets again. But working with land developers, the horizontal construction guys that are buying a piece of dirt, taking it through entitlements, either doing forward sale to a publicly traded home builder or local regional type home builders, or the groups that are doing soup to nuts, right? I would say we really like on the debt side, debt and equity stay $10 million and up check sizes that we're raising. That being said, we are all about relationships, and some groups who are kind of up and coming and have gotten their feet wet a little bit and round tripped, and they started very small and now they're moving up the ranks, and one day hopefully they'll be a big group. But we've done deals down to 5-ish million. But trying to stay more, especially in today's world where banks, lenders, and equity, they're a little bit tighter, right? They went through a tough patch. Everybody was putting out money in end of 2020, 21, 22, beginning of 23, and then rates started really going up. And now some of those groups, they're having issues, right? And they're dealing with asset management issues or bad actors that they invested in, and so they're being more conservative. I'll put it that way.
Yeah, no, everybody's seen that across the board since the rates went up. It seems like everybody's being conservative, and it's getting tougher and tougher to be able to access capital. What have been some of the biggest trends that you're seeing right now in the debt and equity markets for, like land and the land horizontal stuff?
Yeah, so it's a very good question. I was at a lending conference out in Vegas. It's the Western Commercial Real Estate Finance Council event, probably about a little over 2 months ago. And we had it's one of these events where everybody on the West Coast, shows up. That's a lender, and we had, I want to say, 38 meetings in 2.5 days, where we rent a suite. They come up to us, and every 20 to 30 minutes, it's a new group coming in. The biggest thing I learned just from that conference, and not even doing deals on a day-to-day basis, I asked a lender, I go, what are you looking for right now? And they said 3 things: sponsorship, sponsorship, sponsorship. So they want to back people that know what the heck they're doing. And so, and we're seeing this on not just in the land side. I'm living it right now on a great deal in New Jersey on the self-storage side. Family's owned piece of dirt for 30 years, scraping what's currently there, and they're going to build a self-storage property because it's the highest and best use. Because they had all these people coming in wanting to buy the land, and they go, what are you looking to build? And they go, and there was like 3 guys in a row saying, oh, we want to do self-storage here. They're like, well, why don't we do it? And they luckily for them, they've surrounded themselves with really strong team of GC. They own the land. They don't have outside partners, so they own the land themselves. So they have real cash into the deal. But they've never built a self-storage. And so we said, hey, you got to get somebody on your team that has actually done this. You can't just be the GC. That goes, same thing if you're doing, single family homes, or if you're doing land. I know there's probably a number of people on this call that have gone out and acquired land and taken it through the process. And there's always hiccups. And depending on where you're at, the municipality can be a nightmare. I've had one client in particular. He lives in a town, has been a pretty decent sized developer for 40 years, and it's taken him 5 years to get entitlements on and in a town that he lives in. We had a land deal last year that we went out, we raised, and I know we're probably jumping ahead because I know you have a lot of questions for me, but it's a good example. A group that really knows what they're doing. He was a founder of a very large, almost public. They will be public in 2 years. Home builder, built for rent home builder, and he was doing land horizontal, finance. So he bought the dirt, taken through the process. We went out to get him horizontal construction financing, and we were getting ready to close, and all of a sudden, a bald eagle's nest was brought up, sitting in the middle. And this is in Winter Park, Florida, sitting in the middle of 60 acre piece of land in a tree. So, they put the drones up, and nobody ever saw an eagle, but it was a big problem. It delayed us 6 months. And then during that 6-month period, they also found that there was gopher tortoises on the property, and that delayed us, and it had more costs. So, you have to, as an investor, you see a plot of land, you might have some dollars, you and your friends to put money into it, but you got to really dig in and see what's
Yeah. Sounds like maybe they didn't do their endangered species report at the beginning when they should have done it.
yeah.
Oh, so that's really interesting. What has been what have been just some, and I know this is going to kind of differ per deal, but just very basic terms that you're seeing for, land. Let's talk about land banking first and then move on to like the horizontal. Like what terms are you seeing for, deals that are brought to you to do a land banking deal where, they're just wanting to hold it and land bank it, versus doing like the horizontal construction with a contract in place with like a national home builder.
Mhm. And would this be on the equity or
Debt and equity. Yeah, I'm kind of curious. Yeah,
yeah, I
both of
mean,
those ends.
yeah, it depends on check size on the equity, right? I mean, most of the guys we've seen have cobbled together. They're either doing it themselves because they've been in the space and they keep churning their capital, and maybe 1031ing it into the next property once they have a success on one and then the next and keep doing that. Or frankly, for a lot of friends and family, type money or country club capital, as they would say. We tend to, on our side, we're dealing with groups, whether it's family offices or private equity funds, and or very large, high net worth investors that probably have a little bit of a real estate background, where we're bringing in a single check writer. We're not out cobbling together bits and pieces of equity. On that side, it really depends on what are you bringing to the table, experience wise, on you as the GP, right? Because we're going out to look for an LP. Who are you? What have you done? Have you had any issues? What have you round tripped? From start to finish, and from starting to exit. What kind of returns did you? And each deal is obviously different, right? You'll have some home runs, and you'll have some maybe a single, but still win. So really digging into and what's your expertise? Are you a contractor? Do you do a lot in different municipalities where you have relationships with the town councils, and you could sit there? Are you an architect? Like who are you, right? And what value are you adding other than, hey, I have a piece of dirt, and give me some money? That in today's world isn't working as much. So, if somebody's coming in as an LP, they'll want a preferred return on their money. In today's world, it's usually somewhere, I would say 8 to 12% preferred return, and then some type of split of the profits on the back end. And some guys keep it simple, where there's like 1 or 2 hurdles. I've done deals on the equity side with large institutional players like a Carlisle, somebody that you might need a financial engineer to understand the model and where you're making money and where they're actually making money.
Yeah. So it sounds like one of the biggest trends right now, because of the bloodbath that's happened over the last couple of years, is experience, sponsorship.
Yep.
So anybody bringing you something, definitely important that somebody on the team, part of the deal, has some extensive experience, doing the thing that you're asking the capital to do. Equity wise, so you're looking at 8-12% preferred return on the equity, and then some kind of waterfall. I'm assuming you've probably got 2 hurdles. It's a 90-10 and then an 80-20, and then what are you seeing it cap out at 70-30, or are you seeing any type of equity splits that go beyond that?
It's a good question. It depends on who the equity is. If it's an institution, they'll probably have like 3 or 4 maybe hurdles. If it's high net worth, like family office, some of these people, they just like to keep it simple, right?
Yeah.
And maybe it starts a little bit higher, but once you hit a 20% return, maybe it goes to a 60-40 or a 50-50, right? I'm more of the I don't know. I would say more old school, where I'd like, let's just keep it simple and not overcomplicate this and over financial engineer it and nickel and dime.
I am too. That's why we do just straight prefs on a lot of the private money that we raise. Haven't worked with institutions or family offices. We've got like our own little, boutique little fund that we've got, friends and family, people we've met over the years, and it literally simple is better. We just do a high pref, and that's pretty much it. So what? So that's the equity terms. What about on like?
Just keep in mind on the equity, and I just want to touch on this. if somebody's, it goes back to what are you bringing to the table and what do you need them to bring to the table besides just money? And I know I'll jump ahead to probably, I think one of your other questions, but this correlates to this conversation, net worth and liquidity, right? If you're going out, yeah, you have the equity, but you need an acquisition loan, from a bank or a fund to buy that property and to give you the soft costs to go through the entitlements and architects, engineers, and all that, whatever you have to do to improve that value. What do you need from the equity that's coming in? They don't have to, if you have, I don't know, say you have $500,000 liquid, but it's I don't know, $10 million loan or something like that. And you need bank financing, or an institution to give you a hard money bridge loan. You need net worth and liquidity. So traditionally, 10 million loan, you'll need to show $10 million of net worth amongst the partnership. So a lot of times the GPs, we're seeing this a lot nowadays, the GPs don't have it, right? So they need their LP to step up. So the LPs don't need to step up because they have it. But for them pledging that, they'll want something else from you. So that's where the splits might change a little bit. And then that's net worth is usually par with the loan amount. So $10 million loan, 10 million net worth. And then liquidity, I would say traditionally it's 10%. So $10 million loan, you don't have to show $1 million liquid of, between cash, stocks, bonds, I guess nowadays crypto, baseball cards, I don't know, something that's tangible, right? And that's a lot of times where you need that credit enhancement from that equity partner as well.
Mm-hmm.
And there's groups out there that do credit enhancement. All they do is they come in, they show their balance sheets, and they're not actually putting the money up. But maybe you have the money already, but you don't have the net worth liquidity. They will step in. But for that, they want something. So.
Yeah. So if you as the borrower don't have, because most people are bringing some kind of equity to the table, right? They're, like what's very popular with working with these institutions is usually the GP is raising some sort of money. They're either using their own, or if they don't have it, they're raising some sort of money in a preferred class of shares, call it Class A shares. And then you've got the, if it's a GP partner, this institution that's coming in and supplying the additional equity. I just want to understand the term that you just said. So you said that you needed to show $10 million of net worth in order to get a $10 million loan.
Traditionally.
Traditionally in what
so
sense
5 million net worth, $5 million loan, 2 million. It's that's pretty much in all the term sheets that we get from, whether it's XYZ credit union down the street to the biggest, Apollo and the biggest funds out there, the PIMCO, people like that we deal with. That's what they want to see.
Yeah, so this would be like a private source of capital because what I'm seeing is a lot of these like A&D loans, it's a higher interest rate, but you can come to the table with 20% down and they'll potentially finance the rest of it, though it's at a higher interest rate. I'm just trying to figure out, because in order to be able to get debt, I'm assuming these are the debt terms, to be able to get debt, you essentially have to show that you have the equal amount of net worth to get the loan. It just seems like a very, very high ratio, and it's going to weed out a lot of people from being able to get a loan in these environments. Because if you're a GP that doesn't have that net worth, and you're raising private capital, you'd have to raise that much in equity to be able to get the loan. Well, now the deal doesn't pencil because of the cost on the equity to do that. So I guess, is that where these institutions supplying the equity come into play? They'll come in, back the equity in order for you to get the loan or the debt financing?
Yes. Yeah.
So they're essentially acting as a guarantor almost, as one of the GPs saying hey, I've got the net worth for you to be able to get the loan. I'm going to come in as a equity partner. Is that fair to say?
Yeah. No, that's I would say spot on. one thing, and I tell this to a lot of, I would call it up and coming developers and investors. Don't just look at the numbers. Look at, all right, if I get this deal done, where does this take me for building my business and building my career, in this sector. And so a lot of times, somebody will own the land and they're like, well, I'm going to make $10 million on this. And they, sit at the bar on a Saturday night or whatever, and they're at the country club or wherever, and they're bragging to all their buddies, oh, I'm gonna make all this money. And the reality is they don't have the money to actually accomplish, what they need to do on that deal. So I tell people, learn to, breathe, suck up your ego. And if it means you have to partner with a larger group in this sector that's maybe local, that, somebody, or you aspire to be their company one day, sometimes you gotta get started somewhere, right? So suck up the ego, partner with that larger group, take a little bit less money, but you know what? You'll now have that on your resume of, look, I acquired this, I partnered with this group who, it's a successful team and firm. We executed, we made our money, and now I'm moving on to the next deal. Now you're building that track record and that resume that banks and lenders want to see, and that larger equity groups, want to see. And so, it sucks at first, right? But sometimes you just got to do it. Just to, if you really want to be successful in whatever business that you're in, especially in, commercial real estate.
Yeah, it's better to have 10% of a truckload of watermelons than 100% of like a grape kind of thing.
Yeah, 100%.
Yeah, and it works
as well.
So I want to put some context to this. Let's walk through a big deal and then drill it down to like a smaller deal. So can you tell us a story of maybe one of the larger deals you worked on and the mechanics of that? Who was what was the size of the raise? What were the terms of the loan? What did the deal look like? Sponsor background, that kind of stuff.
Yeah, some deals, some of the larger ones, we have to sign NDAs that we're not allowed to.
Yeah, don't tell the name of the people. Just use the actual information without.
Yeah, like I'm looking at a deal that our firm did this past summer. It was in the Tampa Bay area. It was very large land site, 6,200 acres, for a master plan, a large scale master plan community that's going to be built. This had 3,000 finished or near finished residential lots, so it's pretty big site. And I mean, at the end of 10 years from now, what they're projecting now, it'll house over 30,000 residents. And this is something that we did back in July. And so we went out to get them some financing. Some of the lots were finished. Some were still going through entitlement, but they needed a loan, to keep the wheels churning. So we went out, we got them $85 million. We spoke to some very large institutions on the debt fund and private equity fund side, and then we spoke to a number of banks as well. We actually ended up going with a bank on this one. It was it was non-recourse, which you don't see that very often from banks. Most banks want full recourse and arm and a leg and deposits. And that priced at SOFR plus 415, and I would have to look up what the 30-day SOFR is, but I can tell you.
And that's the terms on the debt.
Yeah. So 30-day, we'll call it around 4. SOFR is around 4%, 3.99. So now it's 8.9%
on the debt. Yeah,
8 to
9%. That was from using a local bank though, not a private.
No, I mean, this is a national bank. They're stroking an $85 million check, and
right.
That being said, that's a big deal, right? That's not your normal type of deal. So I mean, I have a deal currently in Palm Beach County, Florida, where client bought some land.
But so hang on one second. On this particular deal, the 3,200 acres, so they used bank debt financing. So it wasn't family office or institutional financing. Well, and what did what was the reason behind the capital raise? Was it equity? Was it just there had to be some equity involved, or was the borrower, did they own the land outright? Or was
So
any
they own
equity
the land
raised?
with equity and equity partners.
Okay.
They had some existing initial debt that had to be taken out, and this was just to get them to the next phase of
So
in the
where did
whole.
you guys come in? Y'all just found the local bank to help them financing it?
No, I mean, this is a group that we've been tracking for a long time, and a lot of dating back and forth.
Okay.
And then we showed them what we've done for other large groups out there, and they said, hey, well, right place, right time. We need we need to raise some capital on the debt side. And so we went out and we were engaged by them. Everything we do is success based, so we don't charge anything up front. When the deal closes, we get paid. Just
And
like
y'all found a local bank? Is that where
no,
y'all,
it was a national bank
or
that
the
we
national bank? I'm sorry.
yeah, a national bank that we have good relationship with.
Okay, I got it.
And
I was thinking local for a second, and I was like, well, how did they? I got it. So y'all use y'all's banking relationship. I mean, those are really great terms
yeah,
too. And so, what was the loan for? To actually develop the land and build the houses, or just develop the land and sell it to like a national home builder?
yeah, well, it's 6,200 acres, right? So there's gonna be parcels and pads that are gonna be sold off to to
Yeah.
recoup money. I mean, it's a very large development. So part of it they're gonna be doing themselves, and then there's bits and pieces, probably retail, whole retail public anchored, shopping centers.
Yeah, they're building a city, like a little mini
Yeah,
city. That's
yeah,
what they're doing.
6,200 acres is definitely that. Yeah.
Okay, cool. So that's a big deal. Now, what about one of your smaller deals, maybe like a mom pop deal? Can you tell us a
Yeah.
story about
So,
one of those?
I
Maybe
have
some of the smaller checks.
I have a client in Palm Beach County, Florida, that we're in the middle of working with right now. So we're actually out the market. They are two local investors. They own a bunch of single family homes. They own some sod farms. Just local guys that have been successful in their respective careers, and they bought some good land, right place, right time for basically nothing. 10 plus years ago, and they've been sitting on it and operating as a sod farm. Um, NVR came to them a couple years back and wanted to build 50 homes on one of their pieces of dirt. So they started with that, and those 50 homes sold out immediately. They actually pre-sold them. NVR did, and so NVR these guys pretty much had it all shovel ready already at that point, and NVR just bought it. This is now phase two, and I wasn't involved in phase one. That was a couple years ago. NVR proved out like, hey, this area, we can sell homes pretty damn quick and be successful. They came back and said, hey, we want to build 400 homes, combination of single family and townhome. So phase one, phase two, split, type of community. Whole different beast. This is, so this would be, my guys would have to do all the horizontal construction, road, sewer, get it pad ready for NVR, which is a whole nother taking. So they luckily know a lot of people, and they have some good contractors that are in the horizontal land space, and so they found the best in class guy locally to partner with them. We went out to raise them about $19 million for this deal. And that includes the publicly traded home builder putting up a deposit, which a lot of them do, which most of you are probably aware of. You buy the land, find a home builder, they put up a nice deposit. What we're seeing today, it's anywhere between 12 and 20% deposit, which in states like Florida, you can use as part of your equity to, into the deal to keep, the construction moving. No different
huge.
than, it's massive, right? It saves you time in going out to all your friends and family and other investors, right? And it makes the banks and other debt funds feel good that, hey, you have a contract now with a takeout with the home builder who has real hard deposits up in cash with you.
Right.
So everybody is aligned. The issue we run into is just their experience. And so that's kind of what we're working through. They do have a strong team around them. They've been successful in other smaller developments. This is just, 400 pads is a lot. And so, we're.
Well, would you say that like a shortcut around that? Because whenever I've encountered that in my experience, all I do is I just go bring in a GP partner that's done it, give them equity, and boom, now they're part of the team, and they can't say that. Like, is that a workaround that's pretty common here?
That's probably the best way to do it. These guys, they're waffling on whether they want to do that or not.
Yeah, understood. Yeah, because the capital has to see that somebody that is, has equity in the deal has done it before. I guess it can't just be the GC, because if that GC walks, then they're gone. It's like, that's your GC. It's not a guarantee they're going to stick around.
Yeah, or the home builder, something happens, right? And they have, a smaller, at least the first deposit was about 500,000. So a lot to all of us, but to a publicly traded home builder, it's kind of a rounding error. It's better than losing 5 million, right? And so,
right.
That it's a dilemma that, going back to, sometimes you have to suck up your ego, and you also have to look at the numbers, right? At the end of the day, a lot of this is math. So does it make more sense, I've gotten to a point where it is ready for construction and start doing horizontal. Does it make more sense to just sell it to a larger group? And will I make more profit doing that? Or will I make more profit, spending the next 2+ years of my life, 3 years of my life, going through all the pain and torture, right? Of being a developer, and hoping that, the takedown schedule goes right and I'm on time delivering. And you have to weigh those options.
Yeah, 100%. And what were the terms on that deal? So they own the land, and they came to y'all to raise
right now on it. So I'm, live in person. So, the banks, this client, they wanted non-recourse. So all the local banks in Florida, for the most part, they wanted recourse, especially for, I would call it an up and coming horizontal developer. So the banks,
it's hard to get.
Yeah. So the banks are out
first.
Right. And
right.
So, it leaves us with debt funds. Most of the debt funds said, hey, come back on their second or third deal. And, my pushback is I won't need you at that point in time. And so, there's a couple of debt funds that we have good relationships with that are local, live within, similar communities with these guys. Kids are kind of in the same school system, and where there's some comfort that, if something were to go sideways, everybody can get together and have a conversation and figure it out. And so that's what we're leaning towards.
So what advice would you give people that are looking to, they have a track record in real estate, but they're looking to get their first, land deal done, and they're going to come and say, hey, I need some equity, or, I need some debt, but they don't have a giant balance sheet. This would be like their first deal. What I'm gathering would be they need to go and bring in a partner with the experience if they're looking to do that and get a large check. So just go find a partner, bring them in, give them a slice of the equity to do the deal. And then, what else? Like, what other advice would you give somebody that's trying to do that? Again, it's their first deal, and they don't have a huge balance sheet.
Yeah, I would say figure out what your strength is, right? Because when you go and ask, that this group to partner with you and come in with money, but you're going to be giving something up, you want to have something to negotiate with, other than like, hey, I'm a nice guy and I have some land. They'll crush you, right? So you have to figure out, again, breathe and say, who am I? and you lay out to yourself, come with them to them with, here's the numbers, not some 5 lines on an Excel spreadsheet. It looks like, frankly, I have 4 little kids. One of my little kids did it. Show that you're a professional, you're somebody that they should be partnering with, especially if you're coming out of multifamily home building, or you've been doing other things and you're coming into this. You probably you understand what it takes to raise money and to get a loan and show value. Have your stuff together. The amount of time that we spend on our side before we have to go out. Sometimes it takes 2-3 months before we can even get out the market on a deal, because our client just doesn't have all their paperwork and their costs spent to date, like things like that. That means a lot.
Mm-hmm.
I had a client this past year. He came to us and he goes, "Hey, I need a construction loan." We're like, "All right, send us your pro forma in Excel and everything else. Let's start looking through this." And we're like, we look at his pro forma and we go, "Where's all your cost?" And it's like, it's not broken out line item. And he's like, "Well, I don't know. Like I have receipts somewhere in like a folder." And we're like,
"Oh,
it just doesn't matter." And we're like, "Yeah, because that's your equity that you've spent to date."
Sounds like a contractor or something that's not business savvy, but knows the business.
From a lot of contractors that they run very successful contracting firms, but when they come into the development world, they think because they know how to build, it's like everybody goes to a bar and has a drink thinks that they can own a bar. Yes, you know how to build, but being on the other side and being a real business person and a developer and needing to go actually sign for the loan, and you got to show where your equity is. You got to show that you have your stuff together.
That makes sense. 2 more questions, then I want to open up for questions for everybody else. So where do you see the most opportunity in the next 24 months?
It's interesting. Like the past, we'll call it coming out of 2020 COVID era, everybody was looking at the smile states, from, I would call it Southern California, Arizona, Texas, the smile, right? The Southeast, Carolinas. What we're starting to see now, and actually there was an equity group we were speaking to the other day. They actually, they said in the past, I guess 12 months, we've seen more deals in the upper Midwest, the Indianas, Ohio's, Michigans, Minnesota's, Nebraska, like places like that, than we have in the past 10 years. There's things have become overpriced in Florida. You have, taxes are still high, right? Property taxes, insurance is going up, 4-fold in states like, like that. And some of these states are overbuilt, like Arizona. How many more homes, can they build? We're seeing values have gone down in certain markets there, 20% since clients have bought multifamily properties 3 years ago. So there is a real need because there's jobs, there's very good institutions, colleges and universities where they're retaining the talent that is going to a University of Michigan or Indiana University or Ohio State, places like that. And there's real jobs for these people. Not everybody wants to live in a multifamily building, especially if you have young kids. But everything's so damn expensive to buy a home nowadays.
Yeah.
Maybe that's why the build for rent has been good. You can have a yard, feel like you have a house, not have to take on all the expenses of owning a house. And it's good for your family. Or if you're a baby boomer that's selling the large house and you just want to downsize, your kids are out of college and you're traveling more, that's why they built for rent. But the upper Midwest has been a big area that people have been focusing on.
And last question, what are you most personally excited about when a deal comes across your desk, like one that just makes you light up?
I'll go back to the breathe factor. A lot of brokers and people, whether you're at an investment banking firm like ours, or you're solo practitioner, working out of your house, when you first see a deal, you feel like a kid in a candy store. It's like, oh, this is the greatest deal, and then you have to then you start peeling back the onion. So you got to breathe and you got to really look at it. And we have a strong team. I don't know, close to 20 analysts and associates that, I helped underwrite the deals. We have people overseeing them. And so we're trying to dig in and see, because we don't get paid until deal closes, right? So if we take something on, am I wasting the next 3, 6, 9 months of my life and not making any money on this because I, didn't take an extra day or two to really underwrite the sponsor and the deal.
So what is it about like what does make you excited about a deal when you get something that comes across your desk, you start peeling back the layers? Like you mentioned the sponsor has the background and the track record. I know that sounds like the number one, because you said, what do people want? Sponsor. Is there anything else?
You have to be on this, at least in my shoes, you have to be on the same page with the client. If the client is coming to you saying, I want 90% leverage, but all debt, you have to tell them they're crazy, right? This is where you have to manage your client's expectations of what the reality of the world is. I don't care what they got back in, I used to have guys back in 2015, 2016 say, well, back in 2006, I got this. And I said, yeah, then what happened in 2008, 9, 10? Like,
yeah,
that's not
ninja loans. Yeah, no income, no job, no assets here. We'll give you a loan. Okay.
Yep.
Awesome. Well, right. So if anybody's got a question, go ahead and unmute and we'll let Justin answer. Yeah. And if nobody's got anything, we'll let Justin go about his day. Yep, Greg.
Yeah. Well, my deal, of course. I've got lots of questions there. I'm currently in the process of one, trying to sell the development to a developer. I have an exit with Lennar, an LOI in place, and we're working on a PSA, 358 unit subdivision. So my goal was to get the exit with Lennar in place and then find a developer to buy it from me. I'm just getting it entitled. They buy it from me at tentative map, but I have to work both paths at the same time. And the second one is finish the lots myself for Lennar. And so going back to the experience, I've been in real estate for 30 years in one fashion or another, but I don't have a track record on large developments, entitlement deals like this, not even, close, and certainly not full cycle. So that's why I want to sell it to a developer. But the way my contract's written with the seller of the land, I'm going to have to close, 90 days after tentative map either way. So that's why I want to go down the raising capital path. So without the experience, I am looking at talking to people that will come in as co-GPs. I've got a guy that has great banking relationships. He's talked to his bank and said his bank will provide the debt. We haven't negotiated a deal yet, but that makes him a co-GP or GP, and I move into LP. So that's a question there, and because I don't have the balance sheet either. So if I'm going to finish these and be the developer, I guess the question is, if I don't have the balance sheet, I don't have the track record, I can build a good story on myself and my experience and where I've gotten this deal to this point, but that's about it. So I think if I'm going to be the developer, I've got to look at co-GPs. So that's my question is, who should I really be looking for? It sounds like someone on a balance sheet level, or this guy who will provide the debt, who becomes that balance sheet.
It sounds like, look, the guy, and I don't know the whole backstory with the guy that is, bringing the debt. Is he bringing any cash with him, or is he just saying, hey, I have a good banking relationship?
It's just going to be the banking. He said he can provide the debt. So I would need to get the equity as well.
Speaking to me saying, yeah, I'll go raise you the debt and I'm gonna put in no money. But I also want, a piece of equity in your deal. Like, you don't need that guy, right? Yeah. What you need is, a co-GP or a larger LP to come in and with cash and, give you that credit enhancement of the balance sheet and experience, doing a larger, property like this. And so I would focus more on those groups that have real money, not some guy that's trying to get a large part of something for not putting any money up. And
okay. So it sounds like I'm trying to figure out the sequence I should go. I was thinking now, okay, now I'm the developer. I'm going that route. I can't sell it to a developer. And what I was thinking is I should get some term sheets on the debt first before I go to equity partners, credit and co-GPs,
I,
whatever.
I would say,
Or do you think it's the opposite?
yeah, I think it stops it. I mean, debts won't be there if you have the right equity partner. And
Yeah.
Okay.
and keep in mind, depending on who the equity partner is, if it's a larger institution and they like to be, they would rather put in more cash and take a 50%, loan to cost loan compared to, some groups say, hey, go get a 70% loan to cost and we'll, put in the rest of the 30. I mean, you got to know who your partner is, because the debts will say who's the equity and the equities will say who's the debt. And, that's where kind of where we come in, and this is what we do, right? We figure out the jigsaw puzzle of the capital stack with you. So
Okay. And is that like your firm or other firms like yours is a deal I mean, I haven't seen the deal, but let's just the person, right? Like, my situation on a very high level now. I don't have the experience. I've got the deal. It's running through entitlements now. I've got an exit built in with Lennar. That's kind of what I have, real high level.
I mean, look,
But
like for us, if we weren't on this call on a podcast, right, and you were coming to me, I would say send us all the information. Let us start looking at it, and let us come back to you with our thoughts and ideas and next steps of how you tackle this. And if we want to work with you and you want to work with us, here's the approach that we need to do this. And we represent enough people in the sector. A couple of my partners are actually out in Scottsdale. I think it's Scottsdale or Phoenix right now at the large Build for Rent conference, and one of them speaking on the panel there. And so we represent some of the big guys. We represent some more local players that I don't know where the property is, but we know enough.
Nevada.
Where is it?
Nevada, northern Nevada.
Okay. Yeah.
Justin, if I'm hearing you correctly, what you're saying is somebody can submit a package and you'll give them feedback like, hey, love the deal. Deal looks good. Numbers are good. Hey, budget, all that looks great. But, we've got the equity, we can bring someone with the balance sheet, but you got to have somebody that has the experience on here. You need to go get a GP. So you'll give them feedback on what they need to keep putting the deal together. Is that right?
Yeah. And it won't be just, hey, this is not for us. This sounds interesting because size, Mountain West has been very popular over the past couple of years. And so, I would have to imagine that there's a good amount of, there would be a good amount of interest on people that would want to partner with you that can, be a credit enhancement to your deal.
Yeah. Well, I'm hoping I sell it to a developer. I've got an LOI coming in from a developer probably Friday, so we'll see. But it's all terms and hurdles. I can't depend on that. So I do want to start working with a firm like yours and looking at it and saying, who do I need to bring in? Because I do have people that do have experience that are willing to put their name on it and will be the operator essentially locally there. A guy that's worked for DR Horton and Lennar, has been in that market for 20 years. He happens to be available. And he did all the development to the south and so forth. So I've talked to him and he's interested. I haven't really, I don't know where to put him in the deal, right? Is someone like a firm or who is providing the debt and equity, would they want that person to then be signing on the loans, on the debt? How that person I insert with the experience, how do they?
If he doesn't have, if he's looking to kind of, come in and, without cash, but he has experience, that's great. But you need somebody with cash, right? Then you can go and get the guy with the experience. Because right now, like a guy like that, he's someone want, hey, I'm your partner. I have all the experience, but he hasn't put any money in. Like that does you're still back at square one where you need to give the money. You could always go out and hire a guy like that once you have.
So if I come to a firm like yours, I come to you with the package. You say, okay, great. You don't have it. Will you guys find the people with the money? They come in as that money partner, and they become a GP, and I'm LP or co-GPs, or are you saying, hey,
Yeah,
it looks good, go find somebody with money?
correct. And then once we have that partnership, and then we will go out and figure out the debt portion.
Okay, so do you help me find that person
Yeah,
that fills in the money hole? Okay, got it. Okay.
yeah. So
Yeah, I mean, that's where I'm at with it right now.
I'll
So
have a chance to speak to you offline.
yeah,
Just and take
okay.
a look.
Yeah. So essentially, just to kind of simplify it, like that's what Justin does. It's debt and equity. Everybody, in my opinion, everybody can go find debt. I think debt's really easy to find. That's why we do the whole capital raising machine, is because that's to raise the equity that's needed to go and finance the debt. What Justin has is a group of high net worth family offices, institutions that are willing to be that balance sheet that can come into your deal, provide that as a partner in exchange for equity in the deal. But one of the things that they want that they're probably not going to provide, and Justin can speak to this, is they need to see another partner in the deal that's going to sign for the debt, right? Their ass is on the line, that has the experience doing these types of deals. Justin, did I miss anything there?
Yeah, that's where whoever would be coming in would probably be the group signing. Greg would be the partner still in the deal, but you're bringing them in for their experience on these larger, 300 plus, pad, community, and for their balance sheet, right? And
Okay. That makes sense. Okay, that's exactly what I needed to know, and because that's where I'm at right now. So that's good to know, and yeah, definitely like to talk to you offline. And then just the last question is how do you guys charge fee wise? Is it all on the back end? Is there anything up front?
no, it's all success based. So when the deal closes, so traditionally if we're putting a joint venture together, we charge 3%. If it's a first mortgage that we're out raising, it's 1%. If it's Pref or Mez kind of, or CPA, somewhere in that middle tranche, it's somewhere around 2%. Is kind of industry standard. But yeah, that's what we
Got it. Okay. Yeah, there's a lot of getting approached and introduced to a lot of people that are, cut us a check for. I had one firm say $150,000. Cut us a check for it. We'll raise money. We'll put it all together for you. We'll,
I'll
What
do that for
happens
you.
if you don't come through?
I bet. Yeah, I was.
Hey,
blown
Greg,
away.
I've made that mistake, by the way, so don't do that. But
Okay,
that's
I'm
probably
not. Yeah,
another thing that I should another thing that needs to go in the course. And I'll give you examples of that. So
Yeah.
a lot of them out there. Yeah.
yeah.
Okay.
I want to be
Thank you.
cognizant of Justin's time. A few more minutes. Do we have time for another
Yeah.
question? Anybody
Yeah.
else got anything before we let Greg go about his day?
Hey, I got a real quick one, Brandon.
Go for it.
Justin,
Okay.
what's your minimum deal size you looking for? 2 million, 5 million? What's that number?
I mean, check size. I would say we prefer to stay $10 million and up. I guess question is like, what are you looking for, and what is the opportunity? And is this just a one-off deal, or is there like phase one,
Well, we've got
phase two?
we've got a potential deal in Middle Tennessee that I don't know what the check size would need to be just yet, because we're really preliminary on it. But I'm not sure it would be 10 million. So that's kind of what I was asking. I think it would be in the single digits.
Yeah, I would say most guys most groups come to us when it's I would call it a little bit more baked, and when you know what the numbers are going to look like. So I would say take a little bit further down the road, and then we'd love to have a conversation with you.
Yeah, Kevin, he mentioned earlier, like, they prefer to stay over 10 million, but they'll look at 5 million opportunities if it's what they're looking for is a relationship, right? Like, hey, if you're an up and coming developer, you got a $5 million deal size, like that's what we do. And you're scaling, and you're growing, and there looks like there's a future relationship there. They want to talk with you, right? Like that.
Yeah. And look, we have
Got it.
Yeah, we have these larger clients that they're looking for product, right? And so if that means that they can come in and partner up and do a joint venture, on a deal, great.
Yeah, I mean, it's all numbers, guys. The guy said he makes 1, 2, or 3%. So if he's searching for $3 million for you, it's going to be just the same to go look for 10 million, maybe even easier than to go find 3 million.
Yeah, I would agree.
Yeah, fatter deal. So
Sure.
All right.
Okay.
Any other
Appreciate it.
questions? Greg, got
No, just how we
Kevin.
get in touch. How we get in touch
Yeah,
with you.
his info is posted in the school community. It's in there.
Okay.
If you look at the post,
Great.
he's got his phone number and his email.
Well,
Linda,
yeah.
did you have a
One
question?
last question. Oh, sorry. Go ahead, Linda.
Linda had a question. Go ahead, Greg.
Well, my question was just speaking about multiple deals. So I have 3 deals in the entitlement phase now in 3 different, one in Boise, and one in Nevada, and then one in Vancouver, Washington. So would that be more attractive to, as far as raising, is raising kind of for all the
Yeah.
deals, so it's diversified and the same operator?
Absolutely.
Okay, cool.
Yeah, look, it's all in that Mountain West region. I don't know. It might be 3 separate groups, or it could be one. It just depends on the deal. But we'd love to
That's
have a chance to
huge.
speak to you.
I actually didn't think about that because I've been thinking about this as like single deals, but like if I had 3 deals, 3 developments in the market where each one of them's not a $10 million check, but combined they are, like that. You said that qualifies?
Yeah. I would say yes. It's obviously his one that he brought up is 380 pads, I
Yeah.
believe.
Yeah.
So
Yeah.